After a period of significant growth in the stock market, investors often start to question the likelihood of a continued uptrend. It's a little nerve-wracking to keep piling money into stocks or funds that have recently shot up in value and have a very small dividend yield. If those investments go down in value, there could be an extended period where you're not making any money at all. To hedge against that risk, consider dividend funds that will continue to pay regular payments. That way, even if the market drops 10 or 20%, the steady cash flow will provide some stability and certainty. For dividend investors looking for some stable income, dividend growth stocks can be a great option. Although they're not always the highest yielding investments, they steadily increase their dividend payments year after year. Here's a list of ETFs that are geared towards consistent growth in dividends that have been screened for profitability, so you'll be content even if the stock market underperforms. Stay to the end to hear about the highest yielding ETF on this list that can provide sizable passive income in addition to growth. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. VIG, Vanguard Dividend Appreciation ETF. VIG is widely known to be an excellent dividend growth fund. It tracks the NASDAQ U.S. Dividend Achievers Select Index, which is a list of companies that have at least a 10-year record of raising their dividends annually. It holds over 200 stocks, including Microsoft, Walmart, Procter & Gamble, and Visa. Consumer discretionary is the largest sector, followed closely by industrials, healthcare, and technology. Although consumer discretionaries can be more volatile when the market fluctuates, the diversification across many high-quality companies helps provide stability. VIG has earned a 5-star rating from Morningstar over the past 5 years. The dividend yield is about 1.7% and the expense ratio is 0.06%. DGRO, iShares Core Dividend Growth ETF. DGRO requires at least 5 years of dividend growth, which isn't very long in the dividend world, so you could expect a little more uncertainty. The fund only holds companies that have been screened for a reasonable payout ratio, or the percentage of earnings that are paid out annually, to help combat that risk. DGRO holds almost 400 different stocks like Verizon, Home Depot, Apple, and JP Morgan Chase, with the largest sector held being financials, followed by technology and healthcare. The dividend yield is about 2.3% and the expense ratio is 0.08%. DGRW, Wisdom Tree U.S. Quality Dividend Growth ETF. DGRW is slightly different than most dividend growth ETFs, but that doesn't mean it's less desirable. Instead of looking at the company's past and their previous dividend increases, it looks ahead to a company's ability and likelihood to grow a dividend. This makes sense because past performance doesn't guarantee future results. The analysis takes into account fundamentals such as long-term earnings growth, return on assets, and return on equity, which are some metrics used to provide insight to financial health. Technology, healthcare, and consumer defensive are the largest sectors, with 300 companies held, such as Apple, Verizon, Coca-Cola, and Altria. The expense ratio is 0.28% and the dividend yield is less than 2%. NOBL ProShares S&P 500 Dividend Aristocrats ETF. A Dividend Aristocrat is a company that has paid and increased its dividend for 25 consecutive years. These are stocks that are widely known for their dividends, like 3M, Coca-Cola, Pepsi, Clorox, and McDonald's. They've been in business for a long time, have stable fundamentals, and investors purchase the stocks because they can rely on them, for the most part. There are currently about 65 stocks in the S&P 500 that qualify for this list, with most of them being either industrials, consumer non-cyclicals, financials, or basic materials. The companies have stable earnings, good fundamentals, and long histories of profit and growth, making them very likely to continue making their payments regardless of the economy. The dividend yield is over 2% and the expense ratio is 0.35%. REGL, ProShares S&P Midcap 400 Dividend Aristocrats ETF. This is similar to the S&P 500 Dividend Aristocrat ETF in that it only holds companies with a history of increasing payments. However, the S&P 500 only holds large-cap stocks, making the midcaps ineligible. Additionally, REGL only requires 15 years of consecutive dividend growth since the midcaps tend to be newer and younger. It's a good idea to have some exposure to smaller companies because they're often overlooked. Investors are too focused on buying the big names they see everywhere, those that analysts are constantly covering and that friends and family are talking about. These are slightly more volatile than large blue-chip alternatives, but that could simply mean more opportunity. There are currently about 60 stocks in this fund, with financials, industrials, and utilities being the largest sectors. It holds smaller, less-known names like Graco, Flower Foods, and Polaris. The dividend yield is about 2.3% and the expense ratio is 0.41%. SMDV ProShares Russell 2000 Dividend Growers ETF. This is a small-cap version of the previous Dividend Aristocrat funds, except it only requires 10 years of consecutive dividend growth, which is still a long time for small and less mature companies. This holds around 75 stocks that are mostly financials, utilities, or industrials. Most of the names are probably ones that you haven't heard of since they're small companies that don't get much publicity, such as Lithia Motors, Heritage Financial, and York Water. But that doesn't mean they don't provide opportunity. In fact, they could be excellent investments that haven't been overbought like some of the big names that we hear of daily. The smaller companies have more room to run than the mega caps, with more risk of course. The expense ratio is 0.41% and the dividend is approximately 2.5%. VSDA Victory Shares Dividend Accelerator ETF. This is a smaller fund with just $330 million in assets that tracks the NASDAQ Dividend Accelerator Index. It holds 74 large and mid-cap stocks. The companies are screened to ensure that they're likely to increase their dividends in the future, and they're weighted based on that likelihood. The top 10 holdings include Nike, Target, McDonald's, and American Financial, with the largest sectors being technology, healthcare, and consumer discretionaries. The dividend yield is about 1.4% and the expense ratio is 0.35%. DNL Wisdom Tree ex-US Quality Dividend Growth ETF. This ETF holds dividend growth companies in developing and emerging markets outside of the United States. It's a good idea to have some international exposure and avoid keeping your entire portfolio in US companies. Most financial advisors recommend keeping 15 to 25% of your portfolio in foreign holdings spread across many different countries and companies. DNL provides exposure to 275 foreign stocks in Japan, Switzerland, the United Kingdom, Taiwan, India, and many others. Technology is its largest sector, followed by healthcare, industrials, and basic materials. The expense ratio is 0.58% and the dividend yield is about 1.7%. VYM Vanguard High Dividend ETF. This ETF provides a substantial dividend yield from one of the most, if not the most, reputable investment companies. It tracks the FTSE High Dividend Yield Index, which consists of common stocks of companies that pay dividends that are higher than average. There are over 400 stocks held, with Johnson & Johnson, JP Morgan Chase, and Procter & Gamble being the three largest holdings. Financials is the largest sector, followed by healthcare, consumer staples, and industrials. The dividend yield is the highest of those mentioned at about 3.1%, making it a very well diversified fund for those who want exposure to higher income investments. The expense ratio is very low, as typical of Vanguard at 0.06%. Purchasing dividend-paying investments can be an excellent way to hedge against market uncertainty, particularly when markets near all-time highs. Although the overall returns of dividend-paying companies generally aren't as good as high-growth alternatives, they can still be very profitable. The regular income can be what's required to keep investors satisfied when markets trend downward or stay flat for long periods. The ETFs mentioned are versatile and are great for retirees who are able to live off their dividends and for younger investors who are many years away from retirement. Consider purchasing them to balance out your portfolio.